We have quite a few videos on the emergence of private debt, as well as how many private equity firms now have private debt funds. In this video, we will go back to first principles and truly break down the main differences between debt and equity from the investor's perspective. We will divide the video into three main parts: benefits of debt and equity to investors, analysis of debt from the investor's perspective, with an example using China's 3 red lines and Evergrande, and analysis of equity from the investor's perspective. And we'll end the video with a final thought. So let's get started by talking about the benefits of debt and equity when looking at debt and equity from the investor's perspective. When a company needs money, it can raise money from both debt and equity. So through debt, the company is borrowing money from you, the investor, or a bank, and in return will pay a fee in the form of an interest rate to borrow that money. Through equity, the company is getting money from you, the investor, or a private equity firm. And in return, the company will be giving up ownership in the company. So the benefits of a debt investment for you as an investor in comparison to an equity investment are that there is lower risk. If the company goes bankrupt, it pays the debt holders first. So you have lower risk if things don't go well. More certainty of cash flows. As long as the company is in business, you can count on the cash flows, and the company actually pays interest using pre-tax dollars. And access to a business. Many private companies may not want to give up equity, and so you can start a relationship with a company by loaning the company money and potentially become an equity investor later in the relationship. Or the debt can convert to equity, but we'll talk about that later in the video. Now, the benefits of an equity investment for you as an investor in comparison to a debt investment are that there is higher return. Through equity, you share in the profits if the company does well. This makes up for the fact that equity is riskier than debt. Influence. If you own equity, you usually have voting rights and may even have a board seat, which can help you influence the company. In private equity, a great way to add value is to invest in companies with the intention of improving the operations of the business, which we spoke about in our video titled Value Creation in Private Equity. And tax benefits. In many jurisdictions, interest earned from debt investments is taxed at a higher rate than capital gains and dividends earned from equity investments. So your return will most likely be taxed at a lower rate using equity. So let's move on to the analysis of debt from the investor's perspective. Since your upside on a debt investment is limited to your interest payments, assuming it's not convertible debt, your primary concern is whether or not the company will remain in business and if the interest payment on the debt is enough to justify the risk. So you need to conduct detailed analysis to ensure that the company will be able to maintain the interest payments to you as the investor. Now, to do so, investors should look at various ratios to make sure that the company is healthy from a solvency perspective. While these ratios can vary, why don't I give you an example using the real estate industry in China? The Chinese government was concerned with the leverage used in the real estate industry. In an effort to force deleveraging, China implemented policies called the 3 red lines that focused around three ratios. Thanks to the help from a recent UBS report, I'll describe below how the 3 red lines works. The 3 red lines are rules for real estate developers that are as follows. Number 1, the liability to asset ratio is less than 70%. This would not include advanced receipts. Number 2, The net gearing ratio is less than 100%. The net gearing ratio is basically net debt to equity. And number 3, the cash to short-term debt ratio is greater than 1 times. Now, if real estate developers violate these 3 red lines, well, there will be rules around the allowable annual growth in debt. In fact, there's a color code scheme as follows. If a company breaches 0 red lines, the color will be green and the allowable annual growth in debt will be 15%. If a company breaches 1 red line, the color will be yellow and the allowable annual growth in debt will be 10%. If a company breaches 2 red lines, the color will be orange and the allowable annual growth in debt will be 5%. If a company breaches all 3 red lines, the color will be red and the allowable annual growth in debt will be 0%. Now, Evergrande, the big Chinese developer that is all over the news because of its potential default, has violated all 3 red lines. Or how most media headlines put it, the firm crossed all 3 red lines. At the time of this video, in late 2021, Evergrande has started to sell certain assets in efforts to achieve better financial health. So investors, when analyzing a company from a debt perspective, it is important that you use metrics to evaluate what the company looks like from the solvency perspective, just like how China has been looking at real estate developers, including Evergrande. Now let's move on to the analysis of equity from the investor's perspective. When looking at the risk-return characteristics of an investment from an equity perspective, well, it's very complex, especially when you're looking at a private company. That's why we are building a comprehensive course that will cover everything you need to know about buying equity in private companies. We cleverly named the course the Ultimate PE Course, PE standing for private equity. You can get on the wait list for early access to the course by clicking the link in the description below and signing up on our website. Now, here's a final thought. Investors, we talked about analyzing debt and equity as if they're mutually exclusive. But as you know from many of our past videos, they're not. For example, there are all types of structures and instruments, such as convertible debt, participating preferred shares, derivatives, such as options and warrants, and more. These structures and instruments can require different types of analysis. With that said, it is important that regardless of the structure, you have a clear idea of if the potential return can justify the associated risk. In this video, we talked about the main differences between debt and equity from the investor's perspective. We talked about the benefits of debt and equity to investors, and we talked about the analysis of debt from the investor's perspective, and we finally talked about analysis of equity from the investor's perspective. If you can think of any other differences of debt and equity from the investor's perspective, please share your thoughts in the comments below. Thanks for watching our video. If you enjoyed it, please click the like and subscribe buttons. And in the description below, you'll find links to our unique private equity newsletter that provides exclusive commentary on recent private equity deals, as well as our website and our LinkedIn page, where you can find more information on many private equity topics. Thanks, and we'll see you in our next video.